Hello, everyone. Thank you very much for joining or listening through our YouTube channel or LinkedIn. Welcome to CFA Society Slovakia Roundtable 2024 January edition. Today, we have a very special guest. It is my pleasure to introduce Jason Voss, CFA. Jason is co-founder and CEO of Deception and Truth Analysis. Jason previously presented for our society. It was during the Corona crisis where all in-person events were canceled. The leadership team of CFA Society Slovakia perceived it as an opportunity, and Jason answered our call. Today is no exception. Thank you very much again, Jason. Also, this would not be possible without our partners and supporters, namely Tatra Banka, CSOB, Erste Asset Management, EY, ProRate, KPMG, Quantic Financial, CMS, Ellen and Overy, and VUB Banka. There are going to be two separate presentations and recordings. This presentation is going to be about investment management and deception, what you need to know. The second presentation will be a separate recording on the topic of NLP or natural language processing. Jason will present known behavioral differences between deceivers and truth tellers as found by deception science. If you are listening to us on YouTube or LinkedIn, then please head to our YouTube channel for the second video. And now, without any further delay, let me head into Jason. Jason, please take it away.
Yeah, my pleasure, Martin, and you deserve some thanks as well because you have consistently requested interesting topics. Like I've looked at the CFA Society Slovakia presentation page, and there are many interesting conversations. I hope to be one of those interesting conversations that people find memorable and useful. Let me share my screen and we can begin the first presentation, which is about deception detection in financial management. First, can somebody confirm that they can see my PowerPoint page? Yes?
Yes.
Perfect. Thank you, Martin. And regarding questions, please feel free to use the chat function to ask the questions if you have them during the course of the presentation. However, I reserve the right to defer if, in fact, my materials end up answering the question, which I'll happily announce. I have allotted in total for the presentation roughly 15 minutes for questions in general. And so just recognize that if you ask questions in the middle of the presentation, that diminishes the Q&A time at the end, which is all fine. I'm here mostly in service to your curiosity about the subject. And I have now been a deception science researcher for 13 years now and have a ton of information and one of the few people in investment management that has scientific information. So I recognize that there's a deep curiosity for this subject. So anyway, the title of today's session is Investment Management and Deception, What You Need to Know. This is the very first time I've presented this material, and Martin had asked me specifically some of these questions. And so I'm really excited to present them for the first time. All right, let's see. There we go. A little bit about my biography. You don't have to read this. It's here more for the record because you're going to have access to the slides going forward. So no need to belabor this point. But the principal part here of note is I'm a former investment manager. I've always had an interest in whether or not the management of companies that I invested in were being deceptive in their communications with me. And I recognized very early in my career in the mid-1990s just how vulnerable I was to the misrepresentations by companies. And I always strive to find a method for discovering that kind of material. And it was very difficult to do so, which eventually that curiosity led me to work with criminal justice professionals as well as law enforcement professionals. And we did history's first scientific research on the convergence of finance and investing and deception detection. And for CFA Institute members, there's a guide. I don't know if it's available on the website still. I know it's for sale on Amazon because I've seen it there, called Lie Detection Guide, Theory and Practice for Investment Professionals, which codifies a lot of material about this subject matter. So if you have a deep interest, it may be that it's available for free as a download at CFA Institute's homepage. It used to be, but it's been years since I've checked, so I can't confirm that. So apologies. Before proceeding, real briefly, I want to talk to you about the purpose of our company. We're a purpose-driven organization. It's extremely important to us. And yes, there's a commercial interest to what we do, but principally we are grounded in compassion and we're trying to bring more truth to the world. We think there's a truth crisis. So many decisions rely upon high quality information, and we fully recognize that it's getting harder and harder to tell what's real and what's not real. And we think that we have a partial answer to that. But this presentation, rest assured, is not about our company, though at the end I'll say a few remarks about our company because we do offer a solution relative to some of these problems. So the overarching structure of the presentation today is we're going to first start, as you can see on this slide, with investment managers' beliefs. This comes directly out of the scientific research that I did with those criminal justice professionals. And then we're going to discuss the consequences of those beliefs that investment managers have about deception. And then we're going to ask about how critical this beliefs versus skills actually has on investment managers. Then we're going to discuss how much deception is actually taking place, and several organizations and researchers have strived to measure just that. And then the fourth thing that we're going to talk about is how frequently markets price deception and whether or not there's signal there if you can in fact measure deception. I think the news there is very encouraging. And then last, I'm going to share with you two solutions that will make you better. One of them is a repeat from the previous presentation I gave. I think it was 3 years ago, Martin. I can't remember. But anyway, the reason it repeats is because it still remains the highest rated deception detection method, and it can be taught very simply in the course of just a very short presentation. I'm going to share that with you, not developed by me, but developed by the woman I did research with, Dr. Maria Hartwig of the John Jay College of Criminal Justice in New York City. So anyway, that's the overview of the presentation today. Let's start with investment managers' beliefs. In short, and probably not surprising because you're likely educated about behavioral bias, it turns out investment managers' beliefs about deception and how to detect it are incorrect. And so this comes directly from one of the papers that Maria Hartwig and I did together. And these are here on the left-hand side, the different behaviors and characteristics which many people feel are predictive of deceptive behavior. You're likely going to recognize some that you may have as your own beliefs. For example, the degree of eye contact, nonverbal versus verbal. Many people think nonverbal is how you detect deceptiveness. The plausibility of something that someone's saying. A principal one is anxiety, that liars or deceivers tend to be more nervous, so on and so forth. And here we asked on a 7-point scale from 1 to 7, the strength of people's beliefs that this is how you detect deception. So you can see the means right here and the standard deviations for that. This is the effect size. So something can be statistically significant, but it can be the case that the effect size is relatively minor. So this also measures effect size using something called Cohen's d. Cohen's d's above 0.7 are ones that there's a large effect size that you would, as a human being, notice if in fact you were looking for it. Below 0.7, it gets harder. Maybe experts can notice, and below 0.3, generally speaking, most people would never notice it, meaning that the effect size is really minor, and only with statistical analyses could you notice it. But in any case, you can see some of these beliefs are, and these are all statistically significant, by the way, in terms of beliefs. Some of them are quite high, right? That deception takes more mental effort, that liars are more anxious. But then some of these are on the low end, if they're rated lowly in terms of how they're rated or associated with deceptiveness, would be said another way, beliefs about what constitutes truthful behavior. So for example, eye contact here at 2.78 on a 7-point scale is very low, so we can interpret that meaning it's associated with truth. In any case, there are only 2 that are on here that are actually associated with deceptiveness. This has been exhaustively tested, and not just by us. A large and gigantic meta-analysis that was conducted where N, meaning the number of participants examined in the meta-analysis, was approaching 15,000 and done globally, found the global average deception detection capabilities of people right around 54%. So it's about 50-50, right? A very low probability that you're going to detect deception, most of us. And trained professionals like law enforcement, judges, customs officials, for example, they actually score lower than 54%. Some of them are in the 51, 52% range. And in addition, they have a very strong lie bias. Investment managers have a very strong truth bias, which we'll get to in just a moment. So anyway, only 2 of these actually are predictive of deceptive behavior, because that's another thing that's been tested is, okay, how successful are you? Let's test you. What did you rely upon in your assessment? And we can test the effectiveness of those behaviors. And in fact, they're all very low. In short, body language does not work for being able to detect deception. I know that's shocking to many of you because there's so much material on television, in novels, throughout the culture that this is how you detect deception. But it's been tested, and I do mean tested, exhaustively, more than 300 times. Nobody has ever found that body language is a reliable and consistently replicable way of detecting deception. But there are techniques that do work, and I'll be sharing some of those with you. So what are the 2 here that are in fact associated with deceptive behavior? First is mental effort. And in fact, many of the techniques that are now being designed by law enforcement to detect deception are designed to increase the amount of mental effort in a question and answer session, because it does take more mental effort to deceive, because you have to have not just the truthful narrative, the actual narrative in mind, but an alternative narrative and all of the ramifications of that alternative narrative present. And working memory for people is very constrained. So it turns out mental effort, if you can increase it in the person you're questioning, for example, if you're an analyst talking to the investor relations person at a company, if you can ask your question in a very complex way, they've provided an answer, but then think of another way of asking the question, or asking a very refined level of detail about a subset of what they've provided as an answer. The degree that you increase the mental effort that it takes is one of the ways that you can detect deception. Said another way, if you're a deceiver, you're going to start to fumble with the answer. Whereas somebody who actually knows the answer, somebody who actually experienced the events that you're asking questions about, it should be relatively effortless because they'll just tap their memory, whereas a deceiver is going to have a hard time. So increase the mental effort is one of the ways that you can begin to discriminate or tell the difference between deceivers and truth tellers. The other one that's up here is cooperation. So if somebody in response to your line of questioning proves uncooperative, it's very often the case that that's a reliable predictor of deceptive behavior. And in fact, uncooperation, or the lack of cooperativeness, is 66% correlated with deceptive behavior. In fact, one of the consistent findings within deception science is that truth tellers have a mistaken belief that the truth will set them free. So if in response to a line of questioning, they're motivated to give you the truth and lead you to the correct answer, because if they get a sense that you're doubting their honesty, they will cooperate with you to provide you with the best answer. So they switch from neutral in a question and answer session to fully cooperative and overly cooperative, whereas deceivers, as soon as you start to drill down, become uncooperative. And it turns out that's exactly the heart of, or the DNA of, the technique I'm going to be showing you, this strategic use of evidence, here in just several minutes. All right, so what about management, or sorry, investment managers' skill set with regard to deceptive detection? Well, deception detection. Turns out we're terrible. In fact, we're worse than the general population. I said earlier that the general population that's been examined globally, 54% is the number. And so let's do something that's kind of a fun exercise. Maria and I, in our research, we asked people investment managers, to estimate their ability to detect deception in their personal lives as well as in their professional lives. And the belief in the personal life is 66%, or 2/3 of the time. Professional life, 68.2%. And so this comes straight from one of our papers in the Journal of Behavioral Finance. But in reality, when we measured their abilities in their personal life, 50.2%. So we're even worse than the general population at detecting deception in our personal lives. And in our professional life, we're just 51.8% able to discriminate or tell the difference between deceivers and truth tellers. So the overconfidence level, quite interestingly, is almost identical in both situations. So We're vulnerable on the front end, which is what we looked at before, because we're using the wrong cues. And then two, we're also vulnerable because we're tremendously overconfident in our abilities. And then the last point on this particular gap between confidence and reality is this figure skewed becomes this 51.8% is as high as it is because there's a 60.6% truth bias. So what does that mean? What it means is when asked to judge the truthfulness of a statement by somebody else, and in this case, we were testing statements from management on earnings calls, we guess as investment managers around 61% of the time that we're being told the truth. So in other words, we have a bias to guessing truth is being shared with us when in fact it's much lower. If we count for the truth bias, the actual deception detection accuracy is not 51.8%, it's around 39%. So in other words, if you have a strongly held belief as an investment manager that you're being told the truth, you might want to check that because it's actually contraindicated. And I'm going to be sharing research later on that actually demonstrates this very point, where this behavior was measured back in August in another scientific paper not done by us. All right, so in short, we're very vulnerable to being fooled. In fact, this is the paper that I was talking about. So this paper was published in August, and what it found was that analysts who give strong buy or buy ratings, that there's a 69% chance or 68.7% chance that deceptive CEOs receive strong buy or buy ratings, but only 41% of truthful CEOs are receiving those high ratings. So in other words, there's an incentive to deceive, and CEOs have noticed this, and so in fact they do engage in some level of deceptiveness. Said another way, the inverse of this, one minus this, shows you that hold sell or strong sell ratings are only 31.3% for deceptive CEOs, whereas for truthful CEOs, 59%. So this is really an interesting result to me because I have long believed that earnings calls, which most people think is the gold standard for discovering information as an investment manager, I've always thought they were management theater, that management rehearses the question and answers, they prepare remarks, and they only take questions from analysts that are very familiar to the company, where they know that the analyst is highly unlikely in a public forum to question or doubt management. And we find that in our own work at Deception Truth Analysis. We offer assessment of earnings calls. We find them 3 times more truthful than regulatory filings like annual reports and quarterly reports. And you can see exactly that incentive right here. The truthful managers, meaning our performance is bad, actually are more likely to have a hold sell or strong sell rating. So the incentives, because it's possible to receive one of these ratings if in fact you're honest about your poor performance, means you have an incentive to deceive on the calls and to only relate information that is verifiably true. So it creates this interesting foggy situation because of the tug of war and the conflicting incentives on these calls. So then this one is especially, I think, hilarious, and maybe that's because I have a dark sense of humor, but strong buy or buy ratings, all-star analysts award them statistically significantly more frequently than non-all-star analysts. Note, it's only a 3% difference, but this is a statistically significant difference. So in other words, the all-star analysts are more easily fooled by the companies than are the non-all-star analysts. So it calls into question the all-star analysts, that they somehow know the company better or have better access to information. This essentially says they're more likely to be fooled than are the non-all-star analysts, which I think is a fascinating result. So then there are the following results that come from a classic paper, which also demonstrate vulnerability. This is not about investment management. This is about people in general. And so this paper is a very old paper. It comes from 1986, but it's frequently referenced in this "How vulnerable are we to being deceived" literature. And what the paper found was that the deeper your relationship, they use this term relational development. They found the deeper the relationship, there's a correlation to you believing that you can tell if somebody that you're familiar with is deceiving you. And if you think about those of you who are parents, you probably have high confidence that you can tell when your children are lying to you, or your significant other, your life partner, or your business colleagues. if asked, you'd probably say, hey, I know this person extremely well. I know when they're trying to fool me. So that's the first thing that they found, statistical significance, that people have that belief. But then secondly, there's a positive association between the confidence in detecting deception and a presumption of honesty, which this is the truth bias that we found before with financial professionals. They have a truth bias. We think in finance and investing, we're more likely being told the truth. I've just demonstrated to you that that's not the case, that in fact, deceptive CEOs get better stock ratings from analysts. The third thing this classic paper found is that when the truth bias increases, a person becomes less accurate in their attempts to separate truth from lies. So in other words, the deeper our connection with somebody, the more vulnerable we are to being fooled. The mechanism of that, in my opinion, notice opinion, not scientific measure, confidence. My reason or for thinking that that's the case is we let our guards down, right? One of the things that deepens our relationship is trust. And the more we trust somebody, the less we question them because they've never betrayed us or they've never let us down. Consequently, we stop checking with the same level of diligence, say maybe you have right now listening to me talk about this subject. So anyway, in short, for this whole section, we're very poor deception detectors because we rely on mistaken beliefs. We also tend to be overconfident. And then as human beings, we tend to be fooled very frequently. So how frequently do companies deceive? Okay, I hope I've demonstrated to you that we're vulnerable to this, and we ought to have deception detection as a part of our repertoire of tools. But how frequently do companies, in fact, deceive? Well, the good news is 3 different sources of research. This paper right here, Hyde, and this, which I quoted before, which was this paper right here, where it said the all-star analysts award higher ratings. They also looked at an estimate of how frequently companies deceive. And this paper right here, which references right there, also explored this issue. And then we have our own company data. So Hyde found, using their machine learning algorithm, that they estimated around 31% of companies are engaged in some form of deceptiveness at any given time. This is on regulatory filings as well as call transcripts. Dyke, when they researched this, and this is research done by the University of Chicago, using a completely different method of estimation. It's quite complex. I won't go into the details here, but they estimated that approximately 30% of companies are engaged in some form of deceptiveness at any given time, with fully 11% likely engaged in some form of outright fraud, meaning that almost everything they say cannot be trusted. We have found on our platform, using our deception detection algorithm, that approximately 32% of companies have some level of deceptiveness. So what you can see, 3 different methods, entirely different because we're relying on deception science, have found roughly a centrality around 1/3 of the time you're being deceived by a company or they're attempting to deceive you. So there is a fairly significant amount of deceptiveness out there. Our 1 standard deviation and above deceptiveness is very closely related to this Dyke study. We also found around 11%. So figure about 1 in 10 companies are engaged in some form of outright fraud, roughly. So how long does it take markets to price deceptiveness? The good news for you as an investor is if you have gotten religion about this subject and you consider it important and you begin incorporating deception detection into your work, markets price it slowly, which means that you have time to measure deceptiveness. That means you can call up investor relations to use the strategic use of evidence technique I'm about to share with you to discover deception, and you can then execute trades based on that. And that signal is not going to be priced away very quickly. So these researchers right here, Chapados, this is research from last year, they found that markets take at least 1/4 to price signals, deceptive signals into prices. For us, we've engaged a company called CloudQuant, who independently validated our platform and that it's predictive of deceptive behavior. And what they looked at was up to 80 days, which 80 trading days, not 80 calendar days. And each month has roughly 22 trading days. So roughly 4 months later, they still found that there's significant alpha that can be earned from measuring deceptiveness and trading based on it. Interestingly enough, they also found significant alpha in T+3 day periods as well after an announcement. But the majority of the alpha is available the longer you go out. There's a little bit in the beginning, and then there's kind of a lull in terms of time period when you enter into a trade based on the signal provided in an annual report, quarterly report, or an earnings call. And then the maximum signal, though, that they found was at that 4-month mark. So if you're a fundamental investor, there's good news for you. You have the time to be able to do this work to implement the trades. And I would actually argue it's a significant advantage, which I'll share with you at the end. So I hope I've convinced you this is an important subject. You should be paying attention. Likely, whatever you're using to measure deceptiveness right now is poor. You're vulnerable, likely because you think you know how to do this. In fact, the evidence shows that you probably don't know how to do this. So you ought to have some sort of solution, because roughly 1/3 of companies are probably being deceptive with you, and fully 10% are probably likely engaged in some form of fraud. So how do you get better? So we're in the home stretch now here. This is the technique that I've been talking about, strategic use of evidence. It was pioneered here by my friend and former colleague, Dr. Maria Hartwig of the John Jay College of Criminal Justice. And she pioneered strategic use of evidence almost, I think, 20 years ago as part of her PhD thesis. And it is now widely implemented by the FBI in the United States, the MI5, in the UK, various customs agencies around the world now use strategic use of evidence. And slowly but surely, it's changing the world of law enforcement and how they approach investigations. Though sadly, it hasn't fully penetrated, because the traditional technique, which I'm going to talk about in just a minute, is called the Reed technique. Not only is it very poor at discovering deceptiveness. Remember, I said that law enforcement are actually worse than the general population. So it has that disadvantage. But then the other disadvantage is that the Reed technique, which is the one you see on television in police dramas all the time, also leads to a high number of false confessions on the part of people being questioned, which is a terrible outcome. Not surprisingly, one of Maria's charitable functions is to try and overturn wrongful convictions based on faulty interrogation techniques. So the traditional interrogation technique, known as the Reed technique, rests on a principal assumption, and that is that anxiety is felt on the part of deceivers in response to a line of questioning. However, multiple people can be anxious for lots of different reasons. They may have an anxiety disorder. An investor relations professional that you're talking to may fear that you would sell your position in the company, and they may have anxiety. There are lots of reasons to be anxious in an interview situation, think job interview situation, beyond the fact that you're a deceiver and a liar. And so the next assumption is that liars feel especially guilty and anxious, and thus the body language cues are likely to leak out. So if we look for body language cues that are indicative of anxiety, we're going to be able to predict if somebody is deceiving us. Thus, the technique is to ask very direct questions with the evidence you have to try and make people nervous, and to be able to increase the gap between truth tellers and deceivers in terms of anxiety. And then you watch for their body language. The problem with this technique is it doesn't work, first of all. Two, if in fact you've gathered evidence, say you're a research analyst for an investment management product, evidence is hard to gather, and you have literally just given your best and most powerful lever for discovering the truth away to somebody, because you've essentially said, in the way police interrogators do, we have a witness who places you at the scene of the crime, right? And so you've just told the person you're questioning exactly which piece of evidence they have to explain in order for you to trust them, which is highly stupid. So in addition to it doesn't work, it leads to false confessions. It's just dumb, because you've given away something that you worked a hard time to discover away, and you've told the actual liar or deceiver what they need to disprove in order for you to trust them, which is foolish. So strategic use of evidence, by contrast, has two very simple assumptions. One, that both truth tellers and deceivers want you to believe them. Well, no kidding. That's a very simple assumption, and it turns out to be true. It's been measured. Number two, though, the strategies for accomplishing this are radically different. So truth tellers, remember I talked to you before about truth tellers, one of their behaviors is that once they get a sense of what you're looking for in terms of information from them, they will actually take over the narrative, and they tend to then start directing you towards the information that you need in order to begin to trust them. Deceivers, on the other hand, in response to a line of questioning, and once they get the sense of, hey, they're getting very close to the truth that I've done something wrong. For example, I may have deceived about gross margins at a company, and thus I've artificially increased earnings, and you're getting close to that. They start to become uncooperative, or they try and change the subject matter And so the response between truth tellers and deceivers is very different in response to these questions, line of questions. So how do you construct questions using evidence strategically, hence the name strategic use of evidence, so that you can begin to notice these behavioral differences? Well, in short, what you want to do is start with very broad contexts and then narrow your context of your questions. So let me give you an investment management example. And the scenario here comes straight from my own career. We used to be one of the largest shareholders of Hewlett Packard when I was a fund manager. And at one point, we were highly suspicious of their earnings, and in particular, their Southeast Asian printer sales, because we had done channel checks. And we had discovered that ink sales looked like they were low relative to our own model of what they should be. And yet Hewlett Packard published results that showed that, in fact, their results were better than our channel checks. Now, obviously, there's sampling error. It could be that we happen to have a bad sample. I think, by the way, that's exactly what happened. But imagine that scenario, and we're going to call up Hewlett Packard. And our evidence that we have here that we've gathered is our channel checks show that printer ink sales are lower. Printer ink sales were very valuable to Hewlett Packard and remain very valuable for Hewlett Packard. It's their principal source of profits in their printer business, for example. So a broad-based question would be, hey, investor relations person, I wonder if you would review the performance of the quarter with me. Very broad. And as they begin to talk about the performance of the quarter, they're going to give you an answer, probably not a very useful answer. But then the next question would be, I wonder if you could take the performance of the company last quarter by region. Talk to me about North America, talk to me about Western Europe, Eastern Europe, talk to me about Asia, talk to me about North Africa, talk to me about Australia, Asia, Southeast Asia, etc. And you could do it by region, and they're going to begin to provide an answer. And they could say, hey, I'm especially interested in Southeast Asia. I know it's frequently a growth market for you. I wonder if you could talk about the performance of the printer ink sales in these various markets. So you've narrowed the context down. You're getting closer to your channel check evidence. You still haven't revealed it. And at that moment, if somebody's been deceptive, they might start getting the inkling of, okay, I'm getting to and approaching the point at which I have to deceive, if in fact they've deceived, and they might start to be on high alert for your line of questioning in your inquiry, whereas the truth teller probably isn't going to care. And in fact, what happened on the Hewlett Packard call, this is pre-video calling, is the guy said, let me put you on hold. I'm going to grab my actual figures and we'll do country by country what our figures were for the printer ink sales. So he behaved like a truth teller. He immediately went to the information that I was asking for and went straight to it. A deceiver might have responded something along the lines of their best performing country, so they don't have to reveal the deception. And our channel checks were done in, if I remember correctly, the Philippines. They were done in, I think we included India in that category. We included China. We included Hong Kong separately. I think we included Taiwan. Imagine, and I think our channel check was weakest in China, which is why we were alarmed. Imagine that answer doesn't include China. Well, that's interesting and noteworthy because it's a behavioral difference and it's unexpected. If then I follow up with, again, a narrower context question, talk to me about China. I know she didn't mention it. And I start to get evasiveness. Well, China's, what it's always been, right? And I get a non-specific answer. That gives me very high certainty that they're likely deceiving me. And in fact, the accuracy of strategic use of evidence is around 88%, so high. So a little bit about us. We use natural language processing to look for more than 30 behavioral differences between deceivers and truth tellers. Those 30 behavioral differences come straight from the deception science literature. It's a science more than 100 years old with more than 8,000 papers in it. And categorically, those behaviors can be described in these categories right here: clarity, authenticity, tolerance, flexibility, precision, and focus. I'll give you a little bit of detail. I didn't put it in the presentation. This is for the people who've made it this far into the presentation on YouTube or with me today. With regard to clarity, clarity is whether or not somebody is being forthright and revealing their choices, and they're being honest with you about the various activities that they've been engaged in. Think strategic use of evidence, as we were just describing. It's the level of forthrightness and sharing that somebody participates in, and they tend to be very precise, where somebody who's deceptive is inauthentic, doesn't want to cooperate with you, so on and so forth. Authenticity, it's been found in the deception science literature that in a social setting, deceivers are overly complimentary. They try and suck up to somebody who they're spending time around, whereas truth tellers don't tend to demonstrate that behavior. They're not being manipulative in their behavior. Tolerance has to do with power dynamics. Deceivers try and dominate conversations because they have to control the interaction between yourself and them because they have a preferred narrative that they have to convince you of, whereas a truth teller does not have that same problem. And so truth tellers tend not to demonstrate control in their conversations. They're more tolerant of the conversation ebbing and flowing all over the place. Flexibility has to do with the willingness to consider alternative narratives. So, for example, if you said, Jason, talk to me about the success rate of deception and truth analysis at capturing deceptive behavior, I'd say we're right 7 to 8 times. However, we're wrong 1 in 8 times. And one of the things I'd like to solve through additional research is to get our type 1 and type 2 error rates closer. My use of, however, says that I'm willing to consider another point of view with regard to my own company. That's flexibility in narrative. Deceivers don't tend to show that because they're trying to convince you of a single narrative, their preferred narrative. Precision is the amount of details that are provided to somebody in their answer. And focus, one of the findings in deception science is that deceivers tend to only like to talk about the past or the future. They don't like to talk about the present moment. So real quickly about validation. We have now been validated that we are accurate 88.4% of the time. So we're very close to strategic use of evidence, but we're automated. We've identified all 10 of the largest top 10 largest scandals of all time with an average lead time of 6.2 years, which plays into my NLP comments I'll be making here shortly. And then independent validation just came from CloudQuant. Just this past weekend, in fact, we got a white paper which is comprehensive, and they found that our signals are predictive of future stock price movements, that they're directionally similar to sentiment but contain additional information, and they found excess returns of our stuff of 6.26% annually above the equal weighted S&P 500, which turns out to be a tough benchmark to beat. So said another way, you can measure deception, and in fact, you can measure deception in lots of different ways, but it turns out to be beneficial. Now I'm at questions. And I apologize, that took longer than I thought. It's the first time I've presented this information.
Yes, this is the time for Q&A. If anyone has a question, this is the right time to ask. We'll wait for a little bit, and if there is no question, we will wrap it up, and then we will stop recording and start recording another presentation about natural language processing.
Well, Martin, if I may, I'm going to ask the audience a question. For the audience, for anybody that is still listening, was any of this material surprising to you? I'm just curious. That helps me take a sample of the audience, because when we present this information, frequently people express some surprise at some of the information that we share with people. Apparently, it's not surprising.
Yes, Marek, please go ahead.
Okay. Thank you very much for your presentation. I think it was very interesting to listen. Yeah, actually, there was some surprising facts to me, because I'm doing asset management for 25 years. Everybody of us has some investment philosophy, some techniques, and there are something like that is happening. But actually, we have some basis, or I have some basic understanding of psychology and this part. Yeah, so I would be in a camp of this traditional approach if you ask me what is the science behind. So I didn't know that there are some, let's say, new information or facts which are supporting some misconception or some different views how to do that. So I think it was very understandable. There are very, let's say, I think, practical facts you mentioned, and these are quite different what I used to think about that. So thank you very much for that, and I definitely will will read a little bit more about that in the future.
Yeah, for me, when I was an asset manager, and Merrick, thank you for your comments. I had a profound sense of how much I relied upon management for what's top line revenue growth likely to be next year. Going down the income statement, what are operating profits likely to be? Are you growing headcount at the company? Are they mostly, middle management? And you're trying to estimate and value the business, and management's the sole source for many of those assumptions. Talk to me about your competitive position and how your new products compete relative to your strongest competitor. And I didn't have an independent way of validating that ahead of time. Obviously, eventually it shows up in performance, but until it shows up in performance, you're quite vulnerable to that. And so I've always had this strong sense of what tools can I use to evaluate this? And when I retired from investment management, I didn't have tools. I still was as vulnerable, I thought, other than having, gained a little bit of experience as an investment manager. So anyway, that was the motivation for developing these tools. Is I have a profound sense of how vulnerable we are as asset managers from companies.
Thank you.
Thank you.
Is there any other question? We have a little bit of time. Yes, Martina, please go ahead.
Hello, Martina is speaking.
We can hear you.
Okay, thank you. So thank you very much. This was very interesting. Also, the previous presentation that you had on financial accounts and documentation and searching for deceptive information in those. My question is about age as a variable. If you have ever studied this variable. I give you an example. What I heard from audit, people who studied audit, that a 40-year-old man or woman will tell you lies without any body language clues. So you cannot really rely on your let's say feelings or your assumptions, your expectations that you used before. And if you have ever studied age of the person that is telling truth or lies, if younger people can be trusted more, to say it more simple, in a more simple way.
Yeah, great question, Martina. I specifically have not researched that. However, in the deception literature, there's an entire subset of studies done within that 8,000 paper body of research on children specifically, because deception as a behavior is considered a higher order brain function. And so by studying children and when they start to learn to deceive their parents or their friends and so on and so forth, is seen as indicative of the development of mind. And so one of the things that people have noticed is that children tell a very high proportion of lies, and that eventually peaks, if I remember correctly, in the mid-20s, so 23 to say 28, and then it starts to decline. However, that's true in normal people. However, there are people who are known as prolific liars. You might have heard the term pathological liar. They're now thought clinically to be two different conditions. Prolific liars have developed a fondness for deception, and they actually tell the majority of lies. They make up approximately, I think, 7% of the population in terms of deceptions, but they count for like 10 times more deceptions than the normal person. So yes, there is an age relation, and the older you get, you tend to deceive less. But then the prolific liars continue, they maximize and they continue to tell high numbers of deceptions. How frequently? It's estimated that they tell a significant lie, meaning something that would really upset another person to discover, that they tell such lies once every 3 hours. So yes, there is research. I have not done it though, myself.
Okay, thank you.
You're welcome.
Thank you for the question. Any other question? We have 10 minutes left. If not, we will not take it to the end. Yes, Marek, please go ahead.
Maybe I will continue that. What's your typical client? regarding this topic?
Yeah, great question. So we have, excuse me, I'm fighting a cold. We have 7 clients currently. 6 of the clients are asset managers. The asset managers range from quant hedge funds all the way through to fundamental investors. So that's a pretty narrow scale. The quant hedge funds are mostly interested in our summary statistics, whereas the fundamental investors are interested in our analyses within documents, because we can show you the themes within documents that a company is being most deceptive about. And then our one client that's not an asset management client is an investor relations firm that advises C-suite employees on crafting codes of ethics and creating ethical culture. And they like us and utilize us because they can evaluate the communications coming out of the C-suite for their level of truthfulness or deceptiveness, and they then provide coaching on how to improve communications, not just from deceptive point of view, but to be more clear, for example, and to be more authentic. And so that's why they utilize us. We have interest from several intelligence agencies as well as private investigations firms, but not as clients yet.
Understand. And typically, are you analyzing the companies, their communication, and their, let's say, public materials?
So we have 2 products. One is called Database, and that is a structured data set where we have coverage of every U.S. company's annual reports, quarterly reports, inter-period reports, and call transcripts from 2008, and it's updated every day. That's just for US companies. But then because we have a general deception detection algorithm, it's the same algorithm we used to score that structured data set. You can score almost any document of your choosing using that algorithm. And clients that use that do things like examine emails, they examine social media posts, they examine newspaper articles, they examine transcripts of interviews provided on television. Some asset managers do expert network interviews where they examine experts within an industry, and they're now examining those for their level of truthfulness as well. And that product, which we call My Data, you can assess almost anything.
Okay. And do you do some, like, say, fact check or some, let's say, validation of assumption? So because based on some algorithms and or some, let's say, logic methods, you have some hypothesis that some company is using not correct data. Yeah, or
yeah, we don't do. Great question. Yeah, Marek, we don't fact check at all. That's a really
you are not
huge
asking
problem.
company, okay, is this true or not?
Yeah, we're using natural language processing to look for evidence of the behavioral differences between deceivers and truth tellers. And so we're looking only at the words. We don't examine the numbers at all. But for the fact that I'm about to present on some of the additional details in the natural language processing presentation, I would give you a more detailed answer, but I don't want to front run that presentation either.
Okay. Okay, thank you very much.
Sure.
Okay. We have 6 minutes left. If there is anyone that would like to ask question, this is the right time. If not, we will wrap it up. I'll leave it for another 20 seconds. If nobody raises her or his hand, then I think we can really wrap it up.
So Martin, one quick comment. If there are questions, inevitably there will be. People will think of questions later today. Just email me. I'm happy to answer questions. And it could be about any topic. It doesn't have to be about our company. I find deception as a subject matter endlessly fascinating. And I'm still a scientist in this space. We just did new scientific research this fall, which was presented at a scientific conference. I'm a very good resource and I understand the investment use cases. Just email me and I'm happy to point you in the right direction if you have questions about the science or of course about us as well.
Okay, thank you very much. Thank you to everyone joining or listening to us on YouTube. We are going to see and hear each other in the next video about natural language processing. The ones who are on the line, please stay for another presentation. If you are listening to us on YouTube, then head to our next video on our YouTube channel. Thank you very much and bye.